problem 2-29. What we're going to do in this problem is we're going to journalize some transactions. And then when we're done journalizing them, we're going to post the data from the journal to the ledger, and the ledger will be in the form of T accounts. That way we can see what the balances of the accounts are. Because remember, the journal does not have any balances. And then we will create a trial balance at the end of the period. So Vincent Yarwood practices medicine under the business title Vincent Yarwood, a medical doctor. During July, the medical practice completed the following transactions. So we have to click on here to open up our transactions. Now notice the transaction is also explained right here too. So we've got Yarwood contributed $68,000 cash to the business in exchange for capital. In other words, the owner invested $68,000 in cash in the business to start the business. So we know cash is an asset and the company has more cash, so that's going to be a debit. And just to remind you, as always, record debits first and then credits. And then in this problem, we are going to skip the explanations. So as I said, we know cash is going up, so that is our credit account, our debit account, 68,000. And now we need a credit account. That's also 68,000. And in what account do investments go in? Other than cash, cash is going to increase, but also capital is going to increase. So remember from our accounting grid here, investments increase capital, and capital increases on the credit side. So we have a debit and we have a credit, and this is Yarwood Capital. Okay, on July 5th, paid monthly rent on the medical equipment, $550. So since it said paid, that means this company is paying. And if this company is paying, cash is going to go down. So cash will be the credit account. So we're going to skip the first line because that's the debit, and we're going to lower cash, and it is $550. So now we have to figure out what the debit account is. Well, if we're renting medical equipment, this sounds like an expense. And we have more expenses, right? So let's see. Expenses increase on the debit side. So that makes sense. So we're going to debit an expense. So we open up our chart of accounts here and find an expense. The closest one we got a rent expense. $550. So rent expense is increasing and cash is decreasing. July 9th, paid $17,000 cash to purchase land to be used in operations. I always like to start with cash because it's the easiest to understand. Since Yarwood is paying cash, cash is going, and remember, cash is an asset. Cash is going down, so that is our credit account. So we skip the debit, go to the second line, which is our credit, and it's $17,000. Now we need a $17,000 debit. And what are we getting out of this transaction? We're getting land. And land, of course, is going to be an asset, and we have more land, so that's going to be the debit because the land account is going up. All right. July 10th, we purchased office supplies on account. So suddenly we have office supplies. Now notice it says we purchase office supplies. It does not say we purchased and used them all up. So since these office supplies have a future value, a future benefit, they are considered an asset until they are used up. So since they're an asset and our office supplies are going up, that is the debit account. Office supplies increasing, $1,800. Now we need an $1,800 credit. So did we pay cash for these? No. It said we bought them on account, which means we're going to promise to pay later. So we have more debt. So debt, of course, is a liability, and we have more debt, more liability. So that is our credit account. So let's look up in our chart of accounts and see what kind of payables we got. We've got accounts payable, we've got advertising payable. Well, accounts payable is better, so we will use that. July 19th, we borrowed $24,000 from the bank for business use. Well, our cash account, which is an asset, is going up. We have more cash, so that is our debit account. Cash debited 24,000, and now we need a $24,000 credit. Well, this is a loan, so we have a liability. And liabilities, we have more liabilities, right? So that is our credit. So always double check to make sure that the credit and the debit, or I should say the debit and the credit, make sense. So we have more liabilities, so that is our credit account. So let's see what type of liabilities we have. Accounts payable, which is usually due within 30 days and do not charge interest. We got advertising payable. We got notes payable. So notes payable is the best liability to use. Notes payable, remember, are longer than accounts payable, and notes payable usually charge interest. So if we're getting this from the bank, do you think the bank is going to charge us interest? Oh, yeah. Also, a notes payable is going to be in writing, because if they're going to charge you interest, they're going to get that in writing. All right. July 22nd, we paid $1,700 on account. Now we paid, which means cash is going down. And of course, cash is an asset. Cash goes down with a credit. So we skip the first line because that has to be the debit. And we're going to decrease cash by $1,700. So what are we getting out of this deal? Why are we paying $1,700? Well, we're paying on account. So what this means is we're taking our accounts payable, which is a liability, and we're paying it off. So our accounts payable is going down. So our accounts payable is going to be the debit account. Next, July 28th, the business received a bill for advertising in the daily paper, and it's going to be paid in August. So remember, this is July. This is July 28th, and we're not going to pay it in August, until August. So this is going to be some type of a payable for us. The business received a bill for advertising, so that sounds like an expense. And expenses increase on the debit side. So that's going to be a debit. So let's see if we have like an advertising expense or a marketing expense. We've got advertising expense for $290. So now we need a $290 credit. And we said we're not going to pay it now, so it's some type of a liability. And liabilities, we have more liabilities, so that's going to be the credit account. So that makes sense. And let's see, we've got, as for liabilities, we got accounts. We don't notice they don't let you choose accounts payable. You have to choose advertising payable. And that makes more sense. Advertising payable, in this case, is more specific than accounts payable. So the reason this company chose to use an advertising payable instead of an accounts payable is because they separately wanted to, apparently, be able to know how much they owe on their advertising account. July 31st, revenues earned during the month. Okay, record as a compound entry. So here's what's going on in this one. So it's the end of the month, and we've got some revenue, and part of the revenue we received in cash, and part of it the customers have promised that they will pay us later. So we're receiving $6,000 cash. Cash, of course, is an asset, and it's going up, so that is a debit for $6,000. Okay, and it says we also have service $5,500 on account. So what that means is $5,500 of our revenue our customers are promising to pay later. What does that sound like? Well, that's an accounts receivable. And accounts receivable is an asset. So we have more accounts receivable, so that is going to be a debit. So AR is going up 5,500. So why did our customers give us $6,000 in cash and then promise to pay us $5,500? Because we sold something. And so which account do we use when we sell something? It's a revenue. So do we have more revenue or less revenue? We've got more. So the revenue account is our credit account. So we add those two together, 11,500. Let's see what kind of a revenue we got in our chart of accounts. We've got service revenue. We can't use unearned revenue because we have earned this revenue. So service revenue is increasing. And then July 31st, paid employees' salaries. We paid office rent and we paid utilities. Record these as a compound entry. So let's go with the employee salaries first. So if we have employee salaries that we're paying our employees, we have an expense, a business expense. So do we have more expense or less expense? Well, we have obviously more. So that expense is going to be the debit. So we got $2,000 debit. And we're going to look for some type of expense like salaries or wages expense. What do we got here? We got a salaries expense. And then we've got office rent. So that's $1,000. And that is another expense too. So we have more rent expense. So that's increasing with a debit. We got rent expense, 1,000. And we've got utilities. So we paid our utilities, which is like heating, water, electricity. So that's an expense too. And expenses, of course, increase on the debit side. So that is a $550 debit. And they probably called it utilities expense, which they did. And then we have to figure out what the credit is. The credit is going to be adding up all these. So we got $3,550. And because it says we paid, that means cash is involved. Cash is going down, so that's why cash will be the credit account. And then July 31st, the business received $1,260 for medical screening services to be performed next month. Okay, this is critical. We've not performed this, but the person is paying us $1,260. So let's record the cash. We know cash is an asset and we have more cash. So cash is going to be the credit account, the debit account. Now, because it says we're not going to perform these services until next month, that means we have not earned this $1,260. So that is going to be an unearned revenue. And if you remember unearned revenue, because we owe the customer this service now, unearned revenue is a liability. So do we have more liability or less liability? Well, right now we have more. So that's why we're going to credit unearned revenue. Because they paid us ahead of time and we've not performed the service. So therefore we owe them a service, and that is a liability, unearned revenue. And then finally, on July 31st, Yarwood withdrew cash. So since cash is involved, let's do cash first. Cash is an asset, so is cash going up or down? Well, it's going down since they withdrew it. So cash is going to be the credit account, $7,400. And now we need a debit. And why did the owner take money out? Well, it's a withdrawal, so that means he or she is spending it. I guess it's Vincent, so that's a he. Vincent's going to spend it on personal use, and that is a withdrawal. So here's our withdrawal account. Withdrawals, do we have more withdrawals or less withdrawals? We have more, so therefore the withdrawal account is the debit account. Here it is. And in the next video, I'll show you how to post these transactions from this journal. Remember, this is the journal right here with the debit and credit column, to the T accounts, which will represent the ledger. Remember, the ledger has balances. This journal does not have balances. So if Vincent Yarwood asked us how much cash we have, we would have to go through all these transactions and add and subtract them. Now, if this company had been in business 20 years, do you want to go through 20 years worth of transactions to figure out how much cash? No, that's why we need to have the ledger, which will be in the next video.